recording. Okay, here we go. All right, guys, for today's psychology workshop, we're going to be looking over how to beat anchoring bias, how to avoid over leveraging, and how to beat loss aversion. Now, I haven't seen a lot of you guys before, but in the past week, trading was definitely tough, especially if you guys trade indices. So, at least for me, I was having a hard time on indices, and I was falling back on a lot of the trading principles I've learned so far throughout the years, about psychology, which is definitely one of the most important parts of my trading. I found myself in a losing streak a little bit last week. Really wasn't happy about that. But I realized that it was definitely my psychology that was leading me into that losing streak. So I was looking at every losing trade, and I was looking for a chance to get revenge on the market and impose my will on it. But that's definitely not how we should be operating as traders, because if you're a trader, you need to wait for the market to give you your opportunity to engage, right? We have so many filters for engagement, so many things we like to take a look at before we even buy into a position. So today I'm going to be looking over some of the things that were messing with me last week and how to avoid them. So let's go into anchoring bias first, right? So what is that? A lot of you guys might not have heard of it, but anchoring bias is a common cognitive bias that can affect traders during decision making. So it occurs basically when a trader relies too heavily on a piece of information, such as the price you bought an asset at or sold it at, and you would just allow it to influence your trading decisions. So it generally leads to poor decision making and losses. And it's basically if we take a look at the price chart here, right? I'll give a clear example here. So if I have, you guys can see this, all right? Everybody can see this?
Yeah, we see it.
Okay. So I'll have my defined dealing range here. Liquidity high is swept, and then we have a low that gets put in here. So I'll just define my dealing range like this, right? Now, if we let's say we didn't accurately know the draw on liquidity, right? So today, if I zoom in on this time frame after using this dealing range here, we're going to see that a lot of people were probably thinking they could get a sweep in here and then go long to target liquidity up here. Why did that not work out? Because on the hourly, we do have this SIBI here. We have a bunch of relatively equal highs here, and that led to selling that targeted, the low of day. But we do have it looks like a seek and destroy profile today. So I don't know what this is. Seek and destroy profile today. So I don't think we're going to be going anywhere really until maybe the PM session. But aside from that, let's say you did decide to go take a long here, right? And you entered right here. So on this fair value gap, on this move up, you thought price would be supported by some sort of breaker here. So we'll take this as our breaker. And we have our 5-minute fair value gap here as well, which supports price. We could set our stop here at the lows and target some highs here. Now this is, without knowing the draw on liquidity, it looks like a pretty valid setup right here. You have your displacement up. Obviously I'm not using the higher time frame here, but you'll notice as soon as you enter, you basically get stopped out right away. And with anchoring, it comes with relying too much on your prior bias without understanding that the market can move in two ways. So the first way that I used to beat anchoring, right, because that definitely happened to me last week. I was definitely way too bullish, more bullish than I should have been, and I got punished for it until the end of the week. But the first way to do it is you got to set clear trading goals. So before you start trading, you have to have clear goals that you set for the day, and you have to have a plan. So now most people's planning here should involve a higher time frame, charting before they get even engaged in the market. Now, if you didn't do this and you didn't see this hourly SIBI here, which would represent a point to sell from right here, then you probably would have gotten bagged on a long position today. If you set your trading plan properly, you have to follow your plan. It's going to help you focus on your strategy and avoid being swayed by like irrelevant information. Irrelevant information being this expansion candle here. If we take a look at this from a higher time frame price perspective on the hourly, let's say, this is a retracement back into a premium right here where we can find, like a premium where we can find sells. The second thing is to wait for the market manipulation, right? So, I mean, clearly here, again, we have a really good example today of market manipulation. We dig into the 1 minute here. Right here, price just booms up. And what time does this happen? 10 o'clock. Great market manipulation time for the market, and it just trapped a lot of people. I know a lot of people that went long today got punished really bad for taking it because, like, the market manipulated, they weren't ready for it. Third thing is you guys have to keep an open mind. Be willing to change your trading bias or approach if market conditions change, and don't hang on to a position just because you bought it at a certain price. So if we take a look at this dealing range that we've defined here, now like we do realize we're in discount. If you're bullishly biased, you could realistically set your stop at the bottom of the range and you wouldn't have like that many reasons to sell it until like a hit down there. But that's going to result in, bigger losses, and most people don't have a risk appetite of around 50 points. So you're definitely going to have to keep an open mind here and don't hang on to your position if you're wrong. Cut losers quick, and that way you'll save your mental capital as well, and you'll understand that your bias wasn't right and you have to redo your bias. The fourth thing is I would use trailing stops a lot. In the past, I haven't used trailing stops at all on because I've been anchored into my position too much. Now, let's say if we take a look at something like this, right? Instead of price dipping down here, let's take a look. We can use the replay tool here. So instead of price just dipping way down there and, stopping us out, what if our trade actually hit? So we would have something looking like this into our fair value gap and breaker block here. We would push. And then, but how far would we push? We don't know. So when we have something like this, you definitely want to secure your profits whenever you can, because what could happen is instead of a down sweep just like this to retrace, you can get a move straight down. Like after we sweep some liquidity from here, and that could completely take you out of your position and just ruin your profits. Now, if you set your stop at break even, that's great. You have a risk-free trade, right? But let's say you keep your stop here, even after you take like a 1-to-1, with your target being like a 1.74 risk to reward, right? If you take your 1-to-1, you're going to have a hard time holding on to that. And if you don't set a trailing stop, if you don't trail your losses like very quickly, because if you trail in profit, you're guaranteed greens every single time. You're not going to be liable for losing on this position because like you're clearly in profit. If you stop, you're going to be in profit, and you might be losing a little bit, but at the end of the day, your account balance is going to be up. Final thing to stop anchoring bias is definitely to take breaks, because trading, as we all know, is stressful as hell. Like, stress is going to make it harder to make some rational decisions, and if you take breaks, you're definitely going to be able to clear your mind and avoid making emotional decisions. Last week, what happened? For 2 days in a row, I didn't take a break. I wasn't using the higher time frame at all. I basically abandoned my plan. Like, that normally never happens to me, but I mean, I guess it can get everyone, right? I didn't take a break from trading. I didn't step back from the market. I was on that shit 24/7. I was looking at the market at times that I knew weren't optimal for trading, and just trying to break it down in any way I could because I wanted to get revenge on the trades that I lost. That just made me take worse trades. So that's going to be it for anchoring bias. We're also going to take a look at how to avoid over leveraging. That was one of my biggest issues from last week, and I know it could be an issue for a lot of people as well. So we are over leveraging. Over leveraging is a big risk in trading, right? It could lead to excessive losses and even wipe out your trading account. I'm sure at least some of us have had moments in time where you had that little lapse of judgment and you bet bigger than you could afford to lose. Your trading account gets blown up. I mean, in funding challenges, so like prop firms funding, like you only have a certain amount of drawdown you can hit before you lose, right? I know like at least 50% of the people here have probably hit their drawdown, their max drawdown on a funding challenge, and had to dial back into it, either reset the account or like reevaluate what they were doing in the trading space. So how do we avoid over leveraging, like to like reduce our losses and prevent wiping out our account? First thing we can do here is set a maximum leverage ratio. So we can do this by limiting our leverage ratio by setting like a max cap that we're willing to use to borrow or use as capital for a position. So higher leverage obviously comes with higher risk. If I take a position, like again, the same position that I had today, or like as this example, right? I went short today, I didn't go long. But if I took this as an example, right? And let's say I take 10 contracts, okay? So this is actually a really good example here because around 25 points, with around like 25 points of stop, because we're following our trading plan here. So let's say my max loss is $500. I take 10 contracts of micros, or one mini. So 25 points on micros or a mini is going to be $500. $500 max loss here, right? But then let's say I did the same exact thing. So let's copy this over. And I did it with 20 contracts. Let's go with 20 contracts of micros. And this would be two minis here, right? Suddenly your loss becomes $1,000. Your max loss becomes $1,000. But it would be on the same position that we would be taking regardless of the risk we have. So what do we stand to gain from this? 44.25 points. It's going to be a positive risk to reward ratio, but you have to think about, can your account take something like this on? If I'm trading, for example, my 150K static account, so what does that start at? You have $1,250 of max drawdown. If I take something like this into consideration, so my 150K static, right, for max drawdown, which one am I more likely to pick depending on like if I start on my starting balance? Probably the 10 contracts of micros, probably even less. If I take 5 contracts of micros, I have $250 of max loss here, right? So let's frame that out. 5 contracts. This is going to be half a mini. So $250 of max loss here, right? And what does that lead to? If I take the 5 contracts, that means, and this is apparent for every trade, so if I were to take a max $250 loss on every trade, that would be 25 points with 5 contracts. I would be able to take 5 trades consecutively, and consecutively, if I lost them all, that would mean I would lose my account. But notice how that's completely different than if you were to take that same trade with 10 contracts, right, on micros. You take a $500 loss each time. You basically have 2.5 trades to lose, and at the last trade, you probably wouldn't even be taking it with 10 contracts. You'd be taking it with 5. You can only lose $250, and if you take it with 10, you're more likely to lose it just as quick, because what do we have? If we have 25 points here, we can't afford to lose this much. We can only afford to lose 12.5, right? And that completely, it doesn't even put our stop like anywhere near like a reasonable area for a stop. It basically covers this fair value gap, which could be wicked through if this trade was going to work, and boom, it's going to stop you out right away. That's why managing your leverage is super important. Second thing is obviously to use a stop in the first place. A lot of people I've seen, like even some people in this server here, have been trading with no stop loss. So like people are holding on to their positions, bag holding them for the longest time for no reason, even after their trade gets invalidated, because they're emotional and they think their trade can turn around. You can avoid losing positions just by using a quick stop. Like most of you guys know this, so I'm not going to go too deep into it. But again, stick to your trading plan is going to be the next thing. If you have a clear strategy in place, right, like where you understand you have like a playbook, right, a step-by-step process that helps you take trades, with entry and exit points, risk management, position sizing, like however you want to frame your plan out. Following that plan is going to help you avoid your impulsive trades and keep your leverage under control. Last week, I definitely over leveraged. That was my thing. I was trading again like my 150K static, and instead of taking like my max size, like for my plan would have been the 20 contracts. So like 20 micros or 2 minis, right, on 150K static. And I was so confident in some of the trades that I ended up taking on 40 contracts or 4 minis, like the max position, right? Now, if we think about that, what's that going to lead to? 40 contracts of micros or 4 minis. That means for every 25 points that we lose on like something like the NASDAQ here, we're losing $2,000. I could not take that loss on, so what did I do? I set my stop to minimal stops, and this is not something that's going to work on the NASDAQ because the NASDAQ tends to have pretty large price swings that you have to account for. So let's say I was setting like a 5-point stop. I was already emotional at that point. I wasn't sticking to my trading plan. I wasn't being disciplined. I was already taking on like 40 contracts here. This is like, it just stopped me out immediately, basically. If you take a look at something like this, if you were over leveraging, thinking this trade was going to work out in your favor, and you did have like some kind of stop like this in place, let's take a look at what happens. Boom. I mean, it's going to wipe you out immediately. If you had your stop even lower than that, it's still going to wipe you out because you can be wrong in trading. That's why we don't over leverage. That's why we stick to the plan. If my plan was 20 contracts, I should have stuck to that in the first place. Wouldn't be where I'm at now, restarting a funding challenge. I mean, I already have a bunch of other accounts as well, but it just doesn't feel good to blow an account for something stupid like this. Like over leveraging should not be an issue that you have unless you're trading emotionally. So an example risk leveraging plan that I have to avoid over leveraging is to start by, it depends on how much you have in your account again, but it's to start by risking 0.5% or 1% of your account. So if I have $100,000 in starting capital, like with no max drawdown, like that's an example, right? Like in most prop firm challenges, you're going to have a max drawdown. So if I use 0.5% of 100K starting capital, I'm going to be risking $500 for the first trade. And then if I take that on an ES E-mini contract, so let's go to ES, right? This is going to be ES here. We can risk 10 points on a single contract or 5 points on 2 contracts to max out this risk, because $500 in terms of risk on ES, like a regular mini contract, is going to equate to 10 points. Or I can use 2 contracts and put my stop a little closer at 5 points. Either way, in this risk leveraging plan example, I'm going to be looking for at least a 1.5 to 2.0 return on risk per trade. So that means I would have to aim for at least 15 to 20 points gained for our trade to be worth it. Now that seems like a lot there, but it just depends on like how many contracts you're using. So if we lose our trade though, and we don't win it, we're going to cut our risk in half. That means we're only going to use 0.25% risk on the next trade until we recoup our original risk of 0.5%. So we're going to be maintaining this 0.25% risk, or $250, right, on every trade until the original risk that we lost is recouped. With this kind of risk management strategy, this is going to prevent us from blowing our account and over leveraging. When the 0.5% risk is recouped, we can return to the original risk and move forward with trading 0.5% until we create a buffer for ourselves, let's say a couple $1,000, where we can start risking more or leveraging in more. So when you trade as well, like you should aim to take risk off at low-hanging fruit and close targets. So for a position with multiple contracts, because like when you reduce your position size, let's say I trade with 2 contracts, right? So in this example, if I'm going to go right here, just on a random short here. Let's say I'm right here. My stop is, I'll give it 5 points for this example, right? So I'm looking for like a 1 to 2 here. And clearly this hits right here. Oh wait, it's not exactly there. We'll use this fair value gap instead. right here. So I'm going to be looking for my 1 to 2. I'm going to be looking for 10 points, right? As you can see, we come into this here, and then, oh, we're actually not at the price target yet. See, now, this is a bad example. That's embarrassing. But you get the point. If we were to hit my price target, right, if I was taking it on with 2 contracts, maybe at a 1-to-1, so instead of this, maybe at 5 points, you'd be taking off half your position. So you'd be taking off 1 contract there. Why are we going to do this? It secures $250 for us. And if the trade completely turns around, like, because this does hit a 1-to-1 here, as we can see, right? Your trade is triggered here, and boom, it's a 1-to-1. But it doesn't hit the 1-to-2 that we're looking for just yet, and it might not. So if we take some risk off the table, we secure our gains, and we don't have as much to worry about. It's going to help our capital, like mentally and physically, because we gain $250 and we have less on the table. So that's going to be it for over leveraging. And then the last topic that I wanted to speak on today is going to be loss aversion. So loss aversion bias is going to be kind of like anchoring bias, but in the opposite way. So loss aversion is, again, a common cognitive bias where people tend to feel the pain of losses more strongly than the pleasure of gains. So when it comes to day trading, this bias often causes traders to hold on to losing positions for way too long because they want to avoid the loss or to take profits too early out of fear of losing the gains they already made. So here's some strategies you can use to beat loss aversion bias. You should set a clear stop loss and take profit level before you enter any trade. So this is going to be pretty easy with the long and short position tools that we have, right? If you're going long, use the long position tool to set your target, your entry, and your stop. This is going to, you sticking to these levels means you agree to the risk you're willing to take on every trade. It helps you map out your risk to reward, and it helps you visualize, your take profit and profit levels. If you determine the max amount you're willing to risk ahead of time, you're going to be okay risking it. And if you're not okay risking it, you shouldn't be in the trade in the first place, right? Second thing is focus on the bigger picture. A lot of the times, I know most of us are day traders here, so we normally do get caught up in short-term fluctuations in the market and lose sight of the bigger picture. Instead of obsessing, right, over every tick in the market, you should focus on your overall trading strategy and long-term goals. If we take a loss on a day, it doesn't mean we're going to take a loss on the week. I mean, it could if you let this kind of stuff get to you, because what happens when you lose? You want to make it right back right away. That's going to be that revenge trading coming in. It's definitely something that hit me hard last week, and I'm not afraid to admit something like that because it helped me grow in the long term. Sticking to your trading plan, practicing mindfulness, just stuff like that, outlining your entry and exit strategies clearly, your risk management, position sizing. If you have a clear trading plan, it shouldn't matter what price does, because at the end of the day, if your trading plan gives you an edge and you're mindful and your psychology is in check because you're not afraid to lose, you're going to be all right. You can be in drawdown a little bit and your position is just going to be fine. If we take a look at a trade like this, right, where we enter from right around here, we'll notice that we're in drawdown. Now, your psychology is going to be completely different. We're only in drawdown for a bit here, but your psychology is going to be completely different in this trade. Depending on multiple variables. Did you just lose a trade before you took this? Did you, have your morning routine set up? Did you chart everything out? Are you confident about this trade, right? If you're in drawdown here, as soon as you enter the trade and it looks like the market could be pushing bullish here, this is the 10 o'clock candle, 9:55, and it was, a nice manipulation up for a short distribution down, right? If you were not mindful of these things, you put yourself in drawdown right here. If you were in drawdown right here based on this trade setup, you would be a lot more scared to even hold on, and you might cut your loss early and just watch the gains happen. But yeah, becoming mindful, aware of your emotions in trading, is definitely something that people have to practice a lot, right? If last week again, I was really emotional when I was trading and I got punished for it pretty hard. Like I took back-to-back losses, and I just stopped sticking to my trading strategy in general. And everything I would do, I would set like some crazy, um, trades up. Like I would look for like something like a 1 to 10 or something like that, like something that looked a little bit like this. And like obviously, like they would never hit really because I wasn't trading high probability setups. I wasn't looking at any of my confluences. I was just trading emotionally. So becoming mindful of that will allow you to beat loss aversion because I understand this week, like with my trading strategy, my trading plan, I'm okay taking a loss. If this trade, let's say I took a short, like this short exactly, and it hit my stop, I understand that if I stick to my plan, which gives me an edge, it's like I'm not going to have that in the future. I'm going to, still be able to profit even if I take losses. And just the last thing is learning from your mistakes. That's the biggest thing. It works for, all three of the things I discussed today: loss aversion bias, over leveraging, etc. Everybody makes mistakes when they trade, right? The key is just to learn from them. The biggest thing that I had to reflect on last week was keeping a trading journal. Like my accountability partner was even telling me, like you should just journal your trades and learn from them, move on from them, and analyze your performance like regularly instead of not being disciplined. Because you know what, a lot of people when they take losses, they just revenge trade right after that instead of journaling the loss. Journaling the loss allows you to reflect on your loss, why it happened, and like look at why your performance is suffering with your strategy. And if you can, to the best of your ability with your journal, you're going to be able to identify patterns in your behavior and then use that to improve your trading strategy in general. Like these are just three basic things I think a lot of us have gone through that like we might need help with. Last week definitely an emotional week for me, but I mean this week I'm up a couple $1,000s like from my trades. I'm back on track. I've been journaling damn near every trade I take, properly applying my strategy. I haven't been over leveraging, just using the same leverage every single time according to my plan, and it's been green. I mean, that's all it really takes. Your psychology is the most important part of your trading, in my opinion. Like, if you have a sound strategy, like you understand it works, you're able to execute on it every single day, or the days where your strategy, presents itself to you, and you're able to, get an edge from it. The only thing that's holding you back is your psychology. So if you guys get that under control, getting your, mental in check, you're going to be able to profit on this strategy way more than if you were to tilt. Like I'm never gonna go back to what I did last week. That hasn't happened to me that often, but it was definitely a learning lesson. And I hope this trading workshop, the three things I went over with you guys today, like with an emphasis on journaling, right, could help you guys out with identifying these problems: anchor bias, loss aversion, and over leveraging. So I'm gonna pass the mic over to Joker now. I know he's got something to say.
Oh damn, you put me on the spot.
No, I had to do it. One time for the one time.
Good thing I was here, man. um, First of all, thanks for doing it. I think it's very important to wait 1 second. Okay, sorry, I'm back. I think it's very important to first of all give back to the community when and if you can. Um, and with that, like just giving from your experience and insights and things that you learn on your own flash, I think it's very valuable. Mm. And more about it because we're talking because it's a psychology talk. uh, I think it's also very important to know and understand that if someone in here or someone that will listen to this recording after it, it's okay to be in tough places in this journey. It's okay. It's okay to have hard times. It's okay to make mistakes. It's okay to feel like shit. It's okay to feel like the world is going to fall on you because it's natural, especially in a profession like this, very high performance, very high demanding, and yes, in a sense, it's a journey that you do alone because it's you versus you. It's always yourself, which is accountable to what's happening. We don't control the markets. Even if we learn how they work, we won't always be right. Um, so if there is someone that really is in a bad place, don't feel bad about it. Don't fear to reach out. And if you don't want to reach out to you, I mean, if people want to, stay with themselves, which is okay, just remember to not let yourself go. Remember to keep putting the work, to journal every day, to journal not only the um how it calls the technical reasons for oh, there was SMT there, so my idea failed. Like put in everything. What is your feelings, emotions before, during, after, because it really helps to understand yourself. Because and that's also the power of journaling. When you just the same with tape reading and journaling, you understand the market, you see how markets work, because you see it live. It's not like when you backtest or you watch ICT lecture. When you watch live the markets, that's how you really learn. And you can, in your mind or in your journal, however you do, you find common grounds, you find profiles, you find reasons for things to happen. So it's exactly the same with your mind. When you also journal your mind, your reactions to things, your triggers to some things. I mean, some people have different triggers. I used to have a trigger which, if I saw an idea and I didn't play on it, then after it I would revenge trade and force ideas. But with time, first of all, I started to be aware of it, and from there I could progress and make myself. I'm predetermined, put myself in a condition where I will frame an idea, I will watch it work, and then don't put a trade. Nothing. Not trying to force anything. Just journal what I feel, journal what I see, and continue. It's just an example for one thing, but it's for everything else. Um, so basically, that's it. Just wanted to give another few words that I think very important.
Yeah, I mean, 100%. I agree with that, Joker. Like, I mean, being able to be disciplined, like, I mean, Zusi shared an example, I think, last week, where you know what price is going to do, and you decide, like, decide not to take the trade in the first place, even though you know exactly what's going on,
Yeah.
is powerful as well because you're being disciplined to yourself. You're understanding that, the trade might, like, do exactly what like you see it doing, but it doesn't meet your trade parameters, and you're just aware of that. So, um, yeah, that's definitely one of the best things about understanding yourself and just becoming aware in general. Now, if anybody has any questions about like how they can improve their psychology or just anything they want to say, like feel free to type in the chat, guys. Otherwise, I appreciate y'all coming to my TED talk.
Great TED Talk, man.
Oh, and for some of the guys that joined late, don't even worry. I am recording it, so I mean, actually, I think I missed a little bit of Joker's voice in the recording, but we're gonna find out soon enough. But yeah, essentially, like if you guys came in late, you guys want to review this psychology workshop, I recorded it. Yeah, don't worry about that. Okay. Good things that you should journal to sharpen your edge. Yeah, I mean, in a journal, like again, like based on what Joker said, right? Like journaling is definitely one of the most important things. Like your feelings in general, and like just determining a playbook for yourself. Because I know, like somebody like Zusi, I know Zusi has a pretty mechanical approach to the market, so he has like a step by step process that he does. Things that added confluence or improved your probabilities to win are definitely some things that you should journal to sharpen your edge, because at the end of the day we're all looking for a trading strategy that's high, like higher reward as opposed to risk, um and like is a clearly defined setup that's able to be repeated over and over again, and that's how we take our wins in the market. So journalizing things that could refine your strategy, things that could add confluence to it or help you visualize the market better, are how to yeah, like definitely things that could sharpen your edge and how to structure your journal.
I would like also to add something for the journal structure, more from the mental side. Actually, it can work for both, but it's mostly for the mental side. It's a system from the book The Mental Game of Trading. I'm sure some know of it. Um, Basically, how you do it, it's a way to solve problems. You can look at it that way. So let's say you have a FOMO or something like FOMO to take a trade, or like a fear of losing the trade. Okay, it's much more common, fear of losing the trade. You ask yourself, first of all, you say, what is the problem? The problem is that I feared to lose the trade, so I didn't take it, or I closed it close to break even, and then it went my way. Doesn't really matter specifically what the. So then, what you do, you ask yourself, what is the logic behind that decision? And after that, after you fully describe the logic, you ask, if it's a mistake, then probably the logic is flawed, right? Because you did something wrong. So you ask yourself, why is the logic flawed? Why is it not right? Why the logic is not in the right place? And after you do that, you give a counter idea, like a logic why you shouldn't be uh, feeling this and this, or thinking, or like, because we talked about, let's say I'll do like a quick full example just so you would understand. So let's say we said about losing a trade. So I said that I fear to take the trade further, okay, and I closed it very close to my entry because I was afraid. Then I say, I try to understand the logic. So the logic for the mistake can be that uh, I'm very anxious about succeeding in trading, and every trade I put a lot of pressure on because I really want to see every trade succeed. And I couldn't see a trade go from green to red, which is a very common advice in the trading community, to don't let a green trade turn red, stuff like that. Um, so in that logic, and then after that, you can give a counter logic into it. You can say that all this you do to yourself, obviously. Um, you can say to yourself that trading isn't a one trade career, unless you just try to hit shit coins and shit like that. So there is no logic behind that fear of one individual trade if it all sums up to the sum of all of the trades, which you will take into time. So it can be 20, 30, 100 trades. It doesn't matter. Um, so then you can so that's how you like give logic into yourself while you are in these bad places. Because after you do these mistakes, you start to get angry with yourself. Why did I do this stupid mistake? So instead of just being angry about yourself and trying to ask yourself in a non-helpful way, you really try to reflect on the things.
Yeah, I mean,
Um, I
100%.
follow
Like
this.
that definitely is, I mean, I guess one of the reasons why a lot of traders struggle a little bit. You just get a little bit angry, you get a little bit emotional. That's again like ties into you got to take breaks from the market. You can't look at the market all day every day. Like if you have a specific session that you trade well and you understand that session, even if you take a loss on it, you shouldn't be trading the session after that if you don't know the price action on it, or you should just be taking a break from the market to self reflect, and you can come back the next day and be way better than you would have been if you continued trading. But thanks for coming to listen, guys. I think that's gonna be about it from me and Joker. If nobody else has any more questions, we'll end the call here.
Can we sell our pyramid scheme now?
And for
Anyone
the
wants
low
to join?
price of $3.99, you guys, you know what I'm saying? Could nah, nah. Thank you guys. Some of the new faces I've seen in here today. I mean, like I haven't met some of you guys before, but thank you guys for tuning in. I really appreciate that. And yeah, I think I think that's gonna be it. Thank you guys.
Thanks, guys.